Welcome to the next episode of Baltimore's podcast with Midfield. We are very happy. Took some time, which is a good thing. That means you're busy to bring on Tibor. Tibor, introduce yourself. Tell us a little bit about who you are, and we'll jump right into things.
Thank you, Yaakov, and the midfield team for having me on. I'm Tibor Wilhelm. I'm originally from Cincinnati, Ohio. I moved to Baltimore to go to rabbinical school in Arizona Rabbinical College on Mount Wilson Lane. And I started Mount Wilson Capital, formerly RPIP Lending, in 2020. It was a very interesting time to start the business. We didn't do so much loan volume then, but someone approached me at synagogue for a loan through a mutual connection. And I had a little bit of money. I just recently got married. I lent him the money, not knowing anything about the business or real estate.
What year was that?
In 2020.
Oh, wow. Okay, thanks.
And it was pre-COVID 2020. And thank God it worked out and it was successful. The guy was a trustworthy guy and still doing business in Baltimore today. And we still do business with him. And I saw that there was this need where you have borrowers that have good credit and have liquidity, but they want to access quick and efficient capital to do their real estate investments because their loans are typically much smaller and there's so much red tape with local banks, regional banks. So I like that space, and then I dove in.
So we're gonna get into the real meat and potatoes later that everyone wants to know about. But to start off, one thing I have to say has been doing this probably a similar amount of time as yourself is that I am definitely very impressed in the way that from 2020 till today, you built up RPIP and now Mount Wilson to where it is, where I think it became the go-to for so many people and outpacing, in my opinion, I mean, I don't know what your numbers look like, but at least when it comes to name, I think it outpaced many other groups that have been doing this for a long time. I think lenders as well known as a dime a dozen, and RPIP or Mount Wilson today is, in my opinion, known as one of the top local lenders for either DSCR or short term. I know you guys got into the DSCR space later on, but in general, even just in my experience, starting off when I used to do wholesaling before I got into the brokerage, I knew that if I had a deal that out of town lenders or people that weren't very knowledgeable, and I didn't want the buyer to work with them anymore, I would send them to yourself because I knew that Tibor could actually execute. If he can't, he'll let me know, but if he could, he will execute. And I think we did a deal like that recently as well. But how, first of all, what do you do different that people just like working with your group?
Yeah, so first of all, thank you so much for the compliment, and we appreciate that. And we really enjoyed working with you guys recently on 3600 Garrison. And I think that's a little bit of our secret sauce. Being that we have a different capital stack than some of these national lenders who are relying on the securitization market and a more leverage and cheaper capital, we knew that in order for us to be successful in the market, we have to be different. And I think what makes us different and sets us apart is we spend a lot of time focusing on client relationships, speed, and efficiency. So when some lenders might market that they could close in 14 days or 7 days, we could actually close in 3 business days if title's clear or less. And then once you start demonstrating that time and time again, then people start noticing. Title companies start noticing, brokers start noticing, wholesalers start noticing, because there's a lot of vendors and a lot of service providers in this business that get paid when transactions close.
Correct.
So if you're the one that's able to provide that service to close, both for the client and for the vendors, then people are going to start wanting to use you. So thankfully we were able to do that. Also, I would just want to give a quick shout out to Aaron Alberti for unlimited contracting. He's been a big mentor and helped us plow our way in the Maryland market. And again, this is another example. He's a big contractor. He does over 300 flips a year, and he wants to make sure that his borrowers, his clients, pay him so he could run his business and have working capital. So if he knows he is a lender that always sends their draws on time, doesn't delay draws, that's another reason why he wants his clients to use us versus other lenders in the marketplace.
Right. And that's exactly why, when it comes to just like really your point, the name of the podcast is Baltimore Real Estate Full Circle. And that's because my belief is that working with others is the best strategy to execute. I closed a deal last week, which until the last minute I thought is going to fall apart. And actually, because the owner called me and said to pull the plug and I had to work around that.
Well,
But what made it happen is because in that scenario, I already built my way in with a relationship to everyone involved, so I was able to help the deal close. And like you're saying, like ensuring that, Aaron's able to bring you more business because he trusts you and you trust that Aaron is going to do a good job in his rehab. So you know that the draws are going to somewhere that they're actually doing the work. All of that is a full circle on trusting each other and really pushing it forward. And I think that, and we'll get into it, I think that chain, not with Aaron, but I think in general in the Baltimore market, I think people are afraid that they've been trusting the wrong people and that things have been going sideways in specific ways. And just a caveat for everyone listening, we're going to discuss things. Um, and at the same time, there's things that, we're going to have to be vague with. And there's things that we don't know 100%. So take whatever I'm saying or Tibor's saying just as our opinion, what we know, which may or may not be correct, but just our opinion to help guide in a unofficial manner what you see that is going on locally. And to start off, really, I remember starting with the wholesaling, which is why I quickly got out of it. I sold about 300 single family properties and got out of it right away. Um, and at the time, it was specifically because I was seeing things that I wasn't happy with, even, things that were legal. For example, if an owner is told he's getting 65 grand, even though technically wholesaling is not illegal locally, you don't need a license to wholesale in Maryland and other places like Philly, you do. It wasn't sitting with me well. I didn't appreciate the non-transparency. And like we know now, there were deals that it wasn't just non-transparent, but seemingly or allegedly illegal um, to some degree. And I think that coming to light, because everything ends up coming to light, everyone thinks that you could just pretend and let things slide. But that coming to light right now, and for those that don't know, there's some very large securitizers and some banks that essentially bought off debt that were being sold off in the secondary market. Before I get into that, actually, if you don't mind, some people may or may not know how that works. If you could give a summary, I know you guys, for the most part, keep your loans in house, but in general, how that works, so that people understand what we're talking about today.
yeah. So, um, we're predominantly bridge lenders. So what we're doing is people are coming to us with deals. We like to focus mostly on fix and flips, not fix to rent. But we do both. We have a mix. And someone comes to us with the deal, and we're going to provide a certain amount of financing for their purchase and for their construction. The construction we're going to do in draws. When we do that, when we make that loan, right? We have a private credit fund that we've raised from a multitude of investors, and we're holding that in house. So we're putting a mortgage in our name, we're holding it in house, and then when they pay us off, we provide a payoff. We release our lien. So what a lot of times what's happening in the market is, so that's for the short term. What's happening in the market is a lot of people are relying on, let's say, a local lender for that short term bridge, but then they want to refinance out into a 30-year loan. Traditionally, historically, this has been done through local credit unions and banks. About, let's say, 7 years ago, 5 to 7 years ago, a product came to the market, which was called the DSCR loan, a debt service coverage ratio loan, which was much less red tape than a bank. And what would happen is they would look at your credit score. Okay, you're a credit worthy individual, and they would look at the cash flow from the property. And as long as both those things checked out and you were able to cover the debt service of the loan you're going to bring on, um, they would do the loan. And that was very, very attractive for people trying to scale their portfolios because, they didn't look at reserves as much. They didn't look at the total financial picture, W-2, income, tax returns. They just looked at, does this property make sense? And are you a credit worthy person? Now, what happens with those loans is with Mount Wilson Capital, we're brokering those loans to third parties. Those third parties, now this gets there's a lot of steps here. There's a lot of tiers here. Those third parties, I'm not going to say names for the purposes of this podcast, but those third party capital partners will buy the loans from us and they'll fund them at the table, right? So we're going to broker it to them. We're going to give them a very, very clean file with the borrower's information, credit, everything, and then they're going to fund it at the table. They fund it, they put it on their balance sheet, and they aggregate millions at a time of these loans, and then they sell it to to another another group of financial institutions who want to balance sheet these um, and hold these for the duration of the loan. And we're talking about billion dollars institutions, $1 trillion of trillion-dollar institutions that need to hold on to a lot of paper because they need to make a yield. And, this is a great way to make a safe yield for this product for long durations of time, right? And it's a hedge against interest rates. It's a hedge against their insurance risk, their premiums. So that's what they do. Now, what happened in our marketplace, and really could be a systemic risk, is that there's a lot of service providers and vendors that benefit from these loans, but don't necessarily share in the risk of these loans once they go upstream. So there's appraisal companies, there's title companies, there's hard money lenders, there's real estate brokers, there's wholesalers, and once these loans were happening, and a lot of people were utilizing this to build their portfolios, um, and they weren't necessarily doing anything wrong. I know there's a lot of fraud that's being mentioned in Baltimore, but there's a lot of deals that are happening that don't have fraud. But at the same time, it propped up values, and people were getting, very good appraisals on these properties, and they were taking out a lot of money, a lot of debt. And because people are taking on a lot of debt, the more debt you take on, the more you have to pay back, and that is an inherent risk. And from our point of view, we think that the valuations on these properties were being propped up by the ability to easily access capital, and that could cause some risk to the marketplace, and we think that, potentially values could come down a little bit once the liquidity leaves the market.
Correct. And I think the core issue with DSCR is that, from my understanding, it really only takes into account principal, interest, mortgage, and it completely forgets about everything else it takes to run a property, especially in a location like Baltimore, where it's going to be a lot heavy turns. You're going to have more turnover, and then you may have a scenario where you're stuck with someone not paying you for months in the property. And the DSCR calculation, in my opinion, goes out the window. I'm not saying they should change it. I'm just saying that at the core of all this, when it comes to the banks approving crazy debt at numbers that really don't make sense if you know what you're doing, like yourself, right? I bet there's times where this DSCR makes sense and you said no to deals if you were doing it in-house, because you know that it's just not what it actually takes to run a deal in Baltimore. And I own the properties. I know that sometimes I make more and sometimes I make less than my calculation, and I try to calculate very, very conservatively on my deals. So at the end of the day, I think that's the first step of problematic when the bank gives the go-ahead for these appraisals, because you're looking at houses that sold to homeowners, right? Or, without mentioning, there was another group that was basically securitizing deals, so to speak, and selling it off to the West investors, people that live in the West Coast, and essentially propping up values. That's, I think, this whole thing. In my opinion, values started slowly going up then, and homeowners also started paying it because they have programs that they could buy a house without any money down. So when you're going to this appraiser, the appraiser may not even doing anything wrong because there's no comps, and the only comps are homeowners because it's a single family.
Right. But the appraiser doesn't understand is that individual didn't have to put any money down, so he was willing to pay a premium.
Correct.
And that house was a premium product. So when you take away the premium product and you take away the fact that, the homeowner didn't necessarily need to have skin in the game because of all these federal and local grants to improve homeownership in the areas, now you're dealing with this rental property. Is the value really there or not?
And I would, in my opinion, the value is not there unless you're selling it to a homeowner, and unless the condition, like you said, is the same. And that's the core of the issue, because even if appraisers, like, I don't know if individually appraisers did or didn't do anything wrong, but even if you were to say that appraisers did their job properly, let's say there was no fraud, I don't know, but let's say there was no fraud in anything, there still is an opportunity for this to happen again, even if everything checks out. Because the issue, like you said, is not, and that's why I say sometimes as a broker, I believe we do better appraisals, so to speak, than an appraiser, because we know what's going on behind the deals. We know whether this was a business that bought the property, whether this person had money coming in that they had to use as a 1031. There's a lot of things that they don't know about when they look at just the apples to apples basis. And sure, there were possibly cases of fraud, but I don't even think the fraud is the main issue, even though it is an issue. The main issue is that these DSCR lenders essentially, because I don't know, whatever, someone in that line of command decided to turn a blind eye because they were okay with the appraisals coming in, which I've seen some of the appraisals, some of them were just, I don't know how they got those numbers, but even the ones that were good, You cannot run a business when your cash flow is $100 after your debt.
Right. I think, yeah, so I agree with you, Yaakov. I think the biggest issue here is just values, right? Like, there was a fundamental issue on valuations in Baltimore City, and it could be an issue in a variety of markets. And it's not really about, yes, there was certain fraud that happened, but it was more of a systemic, a bigger problem, which was there's a value problem. If you guys, if the hard money lenders, the local lenders, I have a bunch of investors that ask me, how are you valuing these properties? How do we know where the LTVs stand? And we say, well, we do some sort of third-party valuation through some, artificial intelligence company. But really, we underwrite these properties and we know the values. And there's nothing better than being boots on the ground and underwriting the values. As you can see in this situation where you're dealing with institutional capital, but they're just turning a blind eye on values. And then on the rental problem, we had a lot of borrowers that were making $300 to $500 of cash flow a month on properties, and that was considered good. The issue with that is one turnover could cost $5,000 to $10,000. So that just wipes out that wipes out your profit for the whole year. So unlike a multifamily property where you're spreading your risk across a bunch of different units and you have more margin of error, with single family you don't have so much margin of error, and the deal really needs to make sense. In order for it to cash flow, you really need good cash flow just in case you have a turnover or deferred maintenance. And I think that was being left behind with a lot of these people that were building huge portfolios because it was so easy to access capital. They just another door, another door, another door.
Correct. And I think, like you said, when it comes to multifamily, the square footage typically of a unit is going to be less than a row home. Now, there's a whole other issue, which we could get into, of getting tenants for apartments, which is a very big issue in today's market as well, or a challenge. But just on a numbers basis, to replace the unit that is 1,000 square feet or 700 square feet, that's making $200 less than a unit that's a single family at 1,600 square feet with a separate roof, everything else separate, that in and of itself, like you said, is going to wipe out your cash flow. And that's why many people I know that own large portfolios know the name of the game for single families is keeping your tenant in there, and even in apartments, but specifically single families, keeping them in there as long as possible. Because the longer you keep them in there, if they're there for 3 or 5 to 3 years and plus, that's really where you're making your money. If they leave before that, you don't really make anything.
Right. And that's why I think there's some of the good operators in the area are very, very focused on specific tenant bases. They want to qualify their tenants. They want to make sure their tenants are good. And they want to also have a premium product. So the tenant goes in and doesn't want to leave. And that's when you start making money. Obviously, these loans are amortizing. So you have less debt to pay. As the years go on, it becomes more of a attractive investment opportunity and greater cash flow.
So getting into, before we get more into the fraud part, as a lender, how are you underwriting the challenge that I'm seeing? And just to be transparent with everyone, I've recently come across challenges in specific sectors of the market where for certain product, it's harder to get tenants, harder to get qualified tenants, and it's harder to fill certain units where in the past it was easier. From my conversations with some of the leasing agents I work with, it seems that right now Section 8's not releasing new vouchers and that the mayor's office programs have been paused as well. I mean, Section 8's going to release more vouchers next year, but it seems that that's an issue. So how are you dealing with that fact? Even though technically, yeah, I could comp these units at whatever Section 8 would pay, but what is Section 8? You're not able to get a Section 8 tenant. Like, how are you underwriting those type of deals?
So for single family properties in Baltimore City, we're being very, very careful on valuations, and we're looking at liquidation values. So we're looking at similar properties in similar areas, and we're understanding this is what these properties could liquidate. This is what it needs to look like. We're not really taking into account what the rent is or what this could cash flow because we don't fully understand the exit strategy right now. It's not fluid of, there are lenders in the market that are still refinancing these loans in Baltimore City. So there is liquidity and there is hope for single family investors that want to continue to grow their portfolio. And I think it's going to get better. But for us, not sharing in the upside as the investor for this rental, we're being very careful and we're being focused on what the liquidation value is. And in regards to multifamily, I think the smartest thing you could do for these, small multifamily deals that we finance is just look at what market rent is, right, and what that looks like. And you have to just underwrite conservatively and put the proper expense ratios, and underwrite the business and operator if he has experience. And that's what we're currently doing. We're still closing deals, but
Right. And to your point of the single family market, I think another question that comes up is that if there is allegedly or potentially 400 properties that within the next 3 years are going to have to be disposed of to some degree, are you concerned about giving out loans knowing that it's an unknown, essentially? And that's even especially the loans you're doing in-house, like, the value might be XYZ now, but I'm seeing it on deals where I'm seeing it, like, right now, I'm getting deals, and right now, to me, it seems like for some type of assets, not every asset, it's a race to the bottom. Mount Vernon, I say this all the time, has so many listings. I'm about to list properties that potentially could be pre-foreclosure there, and the average days on market there's 180 days. A healthy market, it's meant to be 65 days. And I look at that area and every day it's just increasing, increasing, increasing. Your average person doesn't know what's going on. But to what you're doing, how do you try to avoid that risk of an unknown in the next 3 years?
Right, so we love the fix and flip market, so we wanna try to focus most of our capital on people that are providing as much value to the properties, um, as possible. So someone who's, fixing and flipping a property in Glen Burnie, we think there's a lot of opportunity, for 300 to 500,000. We still think there's a lot of demand for that type of asset from retail customers buying homes, and we think there's a lack of inventory. So although we're also seeing on the fix and flip side, we're also seeing that, houses are staying longer on the markets. They require, buyers are requiring more closing checklist items, which is hurting our investors and hurting us. We're keeping our money out there for longer. Payoffs are taking more time, but we still think there is a lot of value in that space. And then, on the rental side, yeah, we're obviously looking at what's going on in the marketplace. What's your thoughts on Mount Vernon? Why specifically is Mount Vernon? Why are you seeing so much assets that are staying on the market there? Why is there less liquidity in that market?
It's a very good question. I think Mount, and this is just my opinion from the data that I've researched. And I think that it could be applied to maybe other areas as well. But I think Mount Vernon has a unique challenge, which is that there was a bubble that was created in Mount Vernon by ownership groups that right now are going into the garbage because they just go on the BBJ. I'm not going to have to mention any names. Go to BBJ and you'll find everything you need to know, where they were overpaying for assets in comparison to what could actually get done. And people had an assumption that, oh, if so many people are paying X, the deal must work. And then you look at rents. So in Mount Vernon, rents could be very high if you do a serious renovation. If you don't, you're not going to get those rents. So it's a double-edged sword. There are some groups that did serious renovations and are getting the higher rents. But because it's such a condensed area with so many units, there's so many multifamily properties and units just in that Mount Vernon area. In comparison to the rest of Baltimore City, where it's a lot more spread out, Mount Vernon has a very, very dense multifamily area. So number one, your competition for rent goes through the roof, especially if you're taking older ownership groups that didn't renovate their properties and were charging very low rents. You're coming in and you're renovating it. But you're not the only one doing it. There's other groups doing it. So you're overpaying just because everyone else is overpaying. But you're expecting rents that maybe one group is achieving because they did a really nice renovation, but now everyone's doing it. So unless you're really charging good rents, which is, in my opinion, lower than maybe the standard, and then you'll get tenants faster, you're going to have a challenge filling at those higher rents. And what happens is it becomes back to the core issue that if you did a basic rehab and everyone's doing basic rehabs and you paid the value that someone else did, whether the other person is now in foreclosure, so day one that didn't make sense, or that person actually put a lot more money into the unit than you did, or bought it in a light nicer condition than you did, you're not going to achieve those rents and you can't make your mortgage payments. And then when things happen like leaks, because those properties are a lot older, they were built in 1890, most of these, and they're historic, so you can't do much with the outside of them. Combine all of that to the market we're in now, where people are like, wait a second, I can't really do anything with my property and I'm not cash flowing, so let me sell it. And they think, oh, I paid X, so I could probably get X, if not a little more, because they don't really look at to the news and they don't really look at what's going on locally. So now they want to sell their assets. But unfortunately, everyone that bought within that time frame, not everyone, but a lot of people, have the same exact issue. So now, slowly but surely, the market gets flooded with people that need to exit. And I have an owner that was going to want to sell his assets for 140 a unit in Mount Vernon, and he came back to me and he wants to sell them for 96 a unit in a matter of 24 months. To give perspective, and that's the challenge in specifically Mount Vernon. I mean, again, it's not exactly apples to apples to everything else going on, but there's a lot of things coming to light with an inflated COVID-19 market that everyone just thought everything is going to be great.
Interesting.
So getting really into, I think the important part, which I know we mentioned a little bit about all the fraud, and that's on everyone's mind. But how can an investor today, what if they're looking to invest in real estate? Where are they going to have the best shot in actually getting financed? And what real estate style investing do you think for right now people should maybe hold off unless they're getting a good deal?
I like to say I like every investor to start with fixing and flipping because then you need money to invest in real estate, and the easiest way to make actual tangible money in your pocket is by fixing and flipping properties. There's a start, there's an end, and then simultaneously slowly getting into the rental game. I think owning rental properties creates long-term wealth, but I don't think it creates cash flow. So if you're thinking about buying rentals, especially in Baltimore City for cash flow, I think you have to revisit that investment idea. Um, Even me myself, I do want to buy more rentals, and I want to own more long term. I want to have more long term real estate investments, but it's hard to do that when you see the fact that people are paying X values for properties and there is no cash flow. So to do something that you're not going to do it to make an investment where you're going to not cash flow anything, that's a hard investment to make. But I think there's still tons of opportunity in the fix and flip business, and I think within the next 12 to 24 months, I think rates will trend lower. I think the Fed will cut rates based on the information that came out in the jobs market recently,
Right.
the labor market. So I think they're trending towards cutting rates. I don't know if it's going to be this current administration with Chairman Powell or the next Fed chairman, but someone will be cutting rates, and I think that will be good tailwinds for the fix and flip business because lower rates, although it's going to create more inventory, I think more buyers will rejoin the market of buying homes.
And it's cheaper for the person that's doing the flip.
Yes, yeah, I think rates will come down a little bit on hard money, but I think that on the back end, more importantly, the retail buyers will have more purchasing power because rates will be lower for their mortgage, and by them having more purchasing power and then being more confident in the housing market, that will make it attract the market for fix and flippers. So I think everyone has to just stay in, continue to hustle, continue to grind it out, and there will be better times.
So the rental, and what's your advice to the people that do still want to buy rental assets? They hear what we're saying today, and for them, they look at it as an opportunity because they think deals are going to be coming in front of them. Are there groups that are seriously lending in today's environment for the long-term DSCR? And how have you seen it change since everything has been announced?
I think that you have to be very cautious on understanding your exit plan by buying rentals in Baltimore City. I also think that it has to financially make sense. So I think that the values that were being propped up by high appraisals, I don't necessarily, even if there are lenders that are still lending in the markets, which there are lenders, I think they're going to be very, very careful about valuations because they got burnt and they see what's going on in the marketplace. So I think you have to just really just buy the property, not for your cash out number potentially, but for the cash flow. And I think values have to come down. And then you have to ask yourself, what cash flow premium are you getting by dealing with the worst asset class? So, let's not kid ourselves. Baltimore City row homes are very hard to manage. So, are you better off paying a little bit of a premium in the county and buying a single family property there, and making a little bit less return on your money, but it's more of a scalable model with a better tenant base, better, better work-life balance than buying a Baltimore City roam. And if you're going to buy a Baltimore City roam, you really need to get paid to do so, meaning the investment really needs to pay out. So I think those are decisions that investors are going to start making. And I know some very knowledgeable investors that are really, that I consider them smart money. And I see that that's what they're doing. They're picking Baltimore City rentals, they're picking small retail strip malls, and that's where they're investing their capital for their long-term real estate investments. They might be a fix and flipper. They do a lot of fix and flips a year, but they also want to build long-term wealth, and that's where they're shifting their money.
And I'll tell you, my personal concern, I'd love to hear your thoughts on this, is that I've noticed that many, many, many of the ownership groups that bought very large portfolios in Baltimore on the single family front are exiting. They're out. And the question becomes, what is going to happen with all these properties in the next 3 years? Like, investors don't want to do it Baltimore City. I see what's going on. It's tooth and nail to get deals done these days. And we have a good strategy to get it done, so we're still executing. But for your average person, what is going to happen to all these properties? Who is actually going to pick them up? Are they going to try to sell it to homeowners? And what type of investor would want to get into it? I mean, it's an interesting question. I don't know.
I don't think there's enough homeowners that are interested in the amount of properties, the amount of inventory that's out there in Baltimore City. I don't see that. So I think that's number one. Number two is I think Baltimore City, I think the real estate market in general is cyclical, and I think Baltimore City's property values is cyclical.
Right.
And I think you're going to see a reset in property values, and then you're going to have some smart investors that are willing to take on the management. They have their in-house management. They have a lot of capital behind them, and they're willing to take on these properties for a certain value. So I think there is a buyer. I don't think all these properties are going to go vacant. Um, and add to the necessarily add to our already big vacant home crisis in Maryland, and Baltimore City. But I think that there's going to be a property value reset, and I think certain investors are going to come in that have good capital behind them and good lenders behind them, and buy up properties where the cash flow actually makes sense.
I agree. I do agree with that point. I do have actually investors that made offers on assets that are in distress, specifically single family market. I just don't think that the lenders are there yet. I think that even lenders that have been a little bit more realistic are not quite there yet. And I think that it's going to hurt in the long term because they're going to make even not make, they're going to lose more than they think they're going to lose, because the values are so far off. You lipstick and a pig and you refi at a 220. So
I think there's a lot of stalemate going on between people that are holding on to these properties, whether it's an investor barely holding on, making its monthly payments, or the lender that got the keys back but doesn't want to take that big of a haircut. And I spoke to a CFO of a very, very large lending company that's doing a lot of 30-year loans, DSCR loans, and they said they're holding on to a lot of properties right now that they think the values, based on the readjusted valuations, based on the actual interior condition of the properties, they think it's 50 cents on the dollar.
correct.
So yeah, that's a big haircut to take. I mean, I know as a lender, we don't like to take any haircut on any loan, period, end discussion. We've only lost money on 2 loans historically,
Wow.
out of over 1,200. But that's because we're trying to be as cautious as possible, and we really, really work through the loans that do go bad. We really, really work them through. But it's not easy to take a loss as a lender, as it is. The margins are small.
So, but how do they have control of it? Are they giving a receiver and then they're going to have to manage themselves? And now essentially they're a management company aside from being a lender?
So that's the problem. These companies are not really even equipped to be management companies, and definitely not management companies in Baltimore City. And single families, that area that were renovated, that have professional squatters. So you're talking about a all-out mess.
Yeah.
So if I was an investor going into the marketplace, I would wait a couple months. Don't get ahead of myself. Wait a couple months, see how things settle, follow the foreclosure auctions, follow the properties, see where things are trading at, follow the auction houses, and kind of speak to people like Yakov in midfield and understand, get industry knowledge, and then, wait and be ready to act.
Right. No, I agree with you on that point. I think that you just have to, it's a weight game with the single family assets. I think multifamily has its challenges. It's not this challenge. I think because in multifamily, a lot of times we look at cap rates, and cap rates, unlike DSCR loan, DSCR ratios don't lie typically, unless they're fed wrong numbers. And that we see, if you read the real deal, you see that all the time, which is a whole separate issue of fraud. But there's a challenge there. But when it comes to single family market, specifically on the portfolio side of things, I definitely agree with what you're saying there. You're just going to have to wait it out a little bit until those lenders are taking a serious haircut. And I do think it's just time for people to realize where the market's at, and it's a race to the bottom. And if you're an owner listening to this, that means that if you really are out of choices, the question is going to become, in my opinion, who is going to act first when it comes to distress? And if you're in distress. All right. If you're cash flowing, then you don't have to be concerned as long as you keep your assets stable. And I've told owners in Mount Vernon that wanted to list with me, you could list with someone else. In my opinion, do not list, keep it stable, and wait this out. Wait out the foreclosure that's going on with this other large investor. And then in 5-10 years, your equity will go back up. And it's the same thing, in my opinion, with the single family. But if you're in distress, you need to think about what's going to happen down the line. And if, according to what we're saying, it might go to 50%, and right now it's at 70%, I would act, even if it's a loss.
See, I think a lot of people are focused on the fraud, but I think the fraud just leads to a little bit of a larger problem, which is there was a lot of investors that weren't doing anything fraudulent, but they were getting really, really high valuations on the properties, and they're holding on to too much debt.
Correct.
So so they didn't do anything necessarily wrong. They might have not made the best fiscal decision for the real estate investment. So that, when you take liquidity out of the market, and when lenders start saying, no, we're not going to give you any more high appraisals, and we're not going to give you cash outs. Well, they need the cash outs to be able to pay for their debt service on their existing portfolio, and that's what they were relying on. So that's what I'm seeing in the marketplace is I'm seeing people having a hard time just handling their current portfolios. And, they just followed the system. They didn't do anything wrong. They're decent investors, but they're having issues with their portfolio.
Correct. And if you can't get, even if you can't, like if your lender is so messed over right now that you're working with and you can't get your draws, you're done. Like what you can't fix the property, you can't finish your rehab. So what are you going to do? And I think what's very interesting, and I don't hear people say this, and kind of what you're saying is it's not necessarily a fraud issue. It is a basic valuation issue. And even the fraud part of it is not a Baltimore issue. It's a mistake being made by having the wrong incentives in play. Like you said earlier, people are incentivized to close deals if they, even though they have no real risk to lose their license from being an appraiser, but that's really it. They have no risk involved. And even the ones that were doing it in a way that's not fraudulent, there's still an issue there. So we have to just rethink. I think the bottom line of this podcast is we need to rethink right now investing in Baltimore. That doesn't mean you don't invest. That means you rethink how to invest and where to invest.
100%. I want to give a shout out to my chief credit officer. A story that happened four months ago. These two individuals, two investors, who are based out of New Jersey, came to our office. They brought us great donuts, so thank you for that. And we were talking. They wanted more leverage for their loans with us, and we were looking at their deals, and we're like, listen, just my chief credit officer is like, listen, the values aren't there. We're looking at the liquidation values. We're pulling up comps, and they're like, look at these appraisals. This is money. Like, you're gonna get your money out, no problem. Like, we get these DSCR loans done in 3 months. This is a home run for you. You make money on the hard money. You make money on the DSCR. This is just a points machine. And for these specific borrowers, we held our ground, and we closed like 3 deals with them at 70% loan to cost. And they're still on our books. And we're laughing now. We're like, listen, we feel really good about our basis on these deals, and we're not scared. Now, hopefully they're going to get out with their DSCR loans, and we're not worried. But it was a come to life moment.
Yeah.
At some point, the music stops. And when the music stops, you don't want to be the one that is holding on to a bunch of properties that are overvalued, because it was great until then. But at that point, all those gains could go away in a second. So that's just it was, for me, it was one of my first lessons, because I've only been in this business for 5 years. It was one of my first lessons, like, wow, like there is cycles, things do change.
Yeah.
It's not just a gradual upwards motion for real estate. There could be some blimps, and you have to be ready, and you have to be prepared to act on those.
Agreed. The one thing that you said, which I cannot agree with more, which I see it in the multifamily space too, is they come with me with their appraisals, and I'm like, sir, you paid the guy $5,000. He's probably, and you're not buying it, he's probably going to make up whatever you want on that. Like, especially multifamily, it's an expensive appraisal. He'll do it for you if it's not actual loan, because his risk there is so low. It's like no one's gonna actually lend on this. They're gonna have to have a new appraisal anyway. So like, sure, I'll do a $5,000 appraisal for you and kind of make up the number that you want. So at the end of every podcast, I like asking the person I'm interviewing if they want to share anything, any thoughts that I may have left out, anything that you may wanted to share with the general listeners before we end it off.
First of all, thank you so much for having me on, Yakov. Thank you to Midfield Real Estate. I think you guys are a great company. You know how to really provide good customer service for your clients, and you know their needs of what they're trying to accomplish. And I think especially when you're trying to sell real estate, you want someone that really understands their marketplace, and you guys really understand your marketplace. On my end, for all the listeners out there, we have a hard money lending company. We also provide DSCR loans. We close super quickly on anything 1 to 4. We don't require appraisals. We send draws the same day. So if you're looking for quick, flexible financing, if you're doing a multifamily deal and your lender's not executing properly, please give us a call. And I think in general, it's not just all gloomy on the market. I think there is always opportunity, and I think you just have to constantly be prepared and constantly be pivoting with your strategy, and wishing everyone success.
Awesome. Thank you so much for your time as always. And I know we're gonna meet again and make some deals happen.
Yes, looking forward to it.